Yeah.
Hello, everyone. Can you all hear me? Hello? Yep. Can you hear me? Oh, wonderful. Hello,
Hello,
everyone.
yes.
Wonderful. Thank you, everyone, for taking the time to join today. Before we begin, I'd like to ask you to put your microphones off and your video off unless you're a speaker. That would help us make sure that everyone sees and hears the speaker in the correct way. Thank you. You can always unmute yourself and ask questions, but we'll get started and then we can turn to that. So everyone, I'd like to thank you for joining USIBC and Witham's webinar on the business landscape for 2021 and beyond, tax and trade. We have a really stellar group with us today, and I'd like to introduce them to you. They're going to do a presentation and share some of their thoughts, and by presentation I mean provide some comments, and then we'll have a question and answer at the end, and we'll get into some instructions on how to do that. But the fact is that there have been tremendous changes in both India and the United States. COVID has been an incredibly challenging pandemic for us. And 2020 was unprecedented in the ways that we have adapted to doing business under the new structure, and also the economic fallout in both jurisdictions with respect to the lockdown measures that were needed to protect the citizens of both jurisdictions. And as we look to 2021, we've had, a new administration come in the United States. And then in India, they just released their union budget for 2021 and 2022. And the union budget, in fact, was a very critical one because it needed to drive the economic growth of India, not only to its pre-pandemic levels, but to help recover from the pandemic itself. So as companies and folks such as yourself start thinking about your business operations in both jurisdictions and building your strategy, it's going to be important to think about what the landscape is and how you're going to navigate it and continue to build your business. To that end, we've been with them as our partner in this discussion of how companies should be thinking about this, not just in one country, but in both. And with that, I want to introduce Daniel Mayo. He is the Principal National Lead for Federal Tax and Policy at Witham. And he has over 20 years of professional tax experience, as well as experience in federal and international and financial products taxation. He is a member of Witham's National Tax Services Group and oversees the U.S. federal income tax research, planning, and review functions. His expertise is in mergers and acquisitions, capital markets, and cross-border transactions. Now, Daniel is a frequent author and speaker on U.S. federal income tax and international tax topics. And I'm particularly pleased to say that he's an approved arbitrator for FINRA, the U.S. securities regulator, and an adjunct faculty member with Georgetown University. So as you can see, he's very well placed to talk to us about the changes that are likely to happen within the United States and internationally. He'll be joined by industry leader Bala Subramaniam, Vice President and Global Head of Corporate Tax at Wipro Limited. Now, Bala also has 20 years of hands-on experience in industry with corporate tax compliance across tax jurisdictions, including India, US, Europe, and Asia Pacific. And he works on addressing structuring requirements, cross-border mergers, acquisition, business reorganizations, transfer pricing, and employees taxation. And he has led India's GST implementation. Now, he's been a leader in many of the audits and settlements with the Indian and global tax authorities. In terms of his thought leadership, he has co-chairman of the Direct Taxation Committee of Bangalore's Chamber of Commerce and Industry. He's a member of the core team of NASSCOM and taxation issues, including GST and emerging global tax developments. And he's led many delegations to the Indian government on various industry issues in his thought leadership roles. Now, he's also a regular speaker on global tax forums. Finally, but least but not at all, and in fact, one of the most important people here today is Rajesh Tripathi. He's a principal at International Tax and a national leader of the U.S.-India corridor at Witham. He has 19 years of experience, and he focuses on Indian companies doing business in the U.S. and U.S. companies doing business in India. He advises U.S. multinationals and foreign public and privately held companies with U.S. operations on international tax issues, daily inbound and outbound tax issues, cross-border taxation transactions, and tax treaties. And one of the most important things is that he is able to advise multinational companies on the entire life cycle of doing business in India. And he works across sectors, and including IT and ITES, infrastructure, financial services, life sciences, media, and entertainment and manufacturing. So as you can see, our panel today is really well suited to talk about what we're facing and how we're facing in terms of the landscape for 2021. So with that, I would like to turn it over to Rajesh to take us through our panel discussion.
Thanks, Nilima, and good morning, everybody who are joining from the US, and good evening for the folks who are joining late from India. As Nilima alluded, that we have all gone through this whole pandemic for 1 year plus years now, and the entire world has been engulfed due to the pandemic. And every country is trying to recover, with this, vaccination coming out. And we have seen that for the last few months, there are two big administrative changes that has happened. One is that the US has the new president who came into the power, plus the oldest democracy, India, had their union budget of 2021-2022 with a vision to become a $5 trillion economy by 2024-25. Now, the objective of today's roundtable discussion will be purely focused on the tax and trade environment with the new US president taking office and the India's budget. A little background on the US-India trade statistic, because the objective of today's webinar is how the US-India trade relationship is looking at with this budget and the new president coming into power. So the US-India trade statistics says that from 1999 to 2018, the trade in goods and services between the two countries surged from $16 billion to $142 billion. India is now the 8th largest trading partner with the United States. And surprisingly, during the pandemic, India's FDI regime has been so liberal that during the COVID-19 pandemic, the country has attracted over $22 billion worth of direct investment, which includes some of the large private equity players from the US, Silver Lake Partners, and the General Atlantic, which basically brought in about $1.8 billion of investment just in 2020, right during the pandemic. Now, going back to the oldest democracy, when it got its new leader, President Biden, and its promise to boost America's economy and finances by raising taxes on wealthy Americans and corporations. With the Democrats controlling the presidency and Congress, what potential changes to the corporate tax rate, capital gains rate, individual income tax rates, and the estate and gift tax exemption amount may be proposed, or maybe something that we are looking at that may come into light. And there could be scaling back of some of the tax cuts made by the 2017 Tax Cut and Jobs Act. Secondly, we will highlight on today's discussion what the India's Union Budget 2021-22 is going to unveil with the hope of the economic recovery due to the pandemic, with the clear objective to attracting foreign companies to do business in India with a long-term commitment of a low tax regime benefits to startups. The budget set up the tone to boost and revive India's economy with a clear vision and plan for a significant increase in capital expenditure, infrastructure development plan, increasing permissible limits of FDIs, which is your foreign direct investment, in insurance sector, promoting domestic manufacturing, including privatization of 2 banks and 1 general insurance company, along with the asset monetization to ensure government has enough money to push for economic growth. As mentioned earlier, the US election ran on an aggressive tax platform. We may see important shift in the outlook of tax policy with the planning would reverse many of the recent tax changes. We may also see that the Biden administration may seek to repeal provisions to the Tax Cut and Jobs Act, as mentioned earlier. Some of the additional Biden business tax proposals include sector-specific proposals that would affect energy companies, real estate business, pharmaceutical companies, and large financial institutions. He has also proposed several Make in America tax measures that seeks to end outsourcing and promote US domestic manufacturing and job creation. With the new government is now focused towards policymaking, there are serious questions about the future of the US tax system right now, and whether and to what extent the dramatic policy changes of 2017's Tax Cut and Jobs Act will remain in place is what we'll have to wait and watch as the Biden administration is coming out with its policy on tax changes. Now, any changes to the US corporate tax regime would affect the cross-border transaction for global MNCs. Some of the business and individual tax proposals that the President Biden's administration is proposing is increasing the US corporate tax rate to 28%, rolling back income and estate tax reduction from 2017 Tax Reform Act for taxpayers with an income of $400,000 or more. Also, the proposal is that the taxing capital gains and dividends as ordinary income for individuals with an income above 1 million, while making other changes that would limit the ability of individuals to use current step-up in basis rules. One key thing that we have seen with the Biden administration is that there is a significant change to the US international tax, especially for the GILTI. Now, what is GILTI? GILTI is the Global Intangible Low Tax Income. And this is something that the Biden administration is proposing to raise from 10.5% to 21%, which was introduced under the Tax Cut and Jobs Act. And just to give a little color of what the GILTI rules are, as all OECD countries with territorial tax systems have designed provisions that seek to prevent base erosion and profit shifting by multinational corporations to complement the transition to territorial system, the US in 2017 passed the Tax Cut and Jobs Act, which included new provisions applicable to the US MNCs, including one of the key things that was proposed in the Tax Cut and Jobs Act that came into power was Global Intangible Low Taxed Income, which is GILTI, a Base Erosion Anti-Abuse Tax, which is a BEAT tax, and the Foreign Derived Intangible Income Deduction, which is the FDII, and a transition tax. To give a little color to GILTI rules require US MNCs to pay a tax of between 10.5% to 13.125% on unrepatriated profits of foreign subsidiaries from intangible assets. The FDII rule is basically income which is it's a very complex calculation, and it is income that comes from exporting products tied to intangible assets such as patents, trademarks, and copyrights held in the US. As mentioned, the FDII computation is very complicated, but is intended to approximate income, the sale of goods and services abroad attributable to the US-based intangible assets such as patent, trademarks, and copyrights. Lastly, the BEAT rules limits the ability of MNCs to shift profits from the US by making deductible payments to their affiliates in low countries. BEAT targets large US corporations that make deductible payments such as interest, royalties, and certain service payments to related foreign parties. The BEAT tax is minimum tax, which is an add-on to the BEAT rate, and the BEAT rate is 5%. It was 5% in 2018. In 2019 through 2025, the BEAT tax rate is about 10%, and it is going to be 12.5% from 2026 and beyond. President Biden's proposal would double the GILTI tax, as I had mentioned earlier, from 10.25% to 21%, and assess a minimum tax on country-by-country basis. But his proposal is silent both on FDII and BEAT. Even though FDII is closely tied to GILTI, as they're both part of the Section 250 deduction, and FDII operates in a tandem with the Global Intangible Low Taxed Income rules, which is GILTI, under 951A. Also, Biden's proposal is penalizing companies that are going to offshore manufacturing and service jobs in order to sell goods or provide services back to the US market by imposing a 10% penalty surtax on such profits. Biden is also very clear that he wants to close offshoring and make sure that there are no tax loopholes to the Tax Cut and Jobs Act. As a part of Made in America initiative and to incentivize domestic companies, a 10% Made in America tax credit would be granted to encourage business to bring manufacturing back to the US and help the recovery of the economy. So these are some of the proposals from the international tax perspective that the Biden government is going to be proposing. And later in the discussion, my dear friend Dan will talk more about what the proposal looks like from the federal government perspective as well. Now, going back to the union budget, what is the union budget that came out in 2021? It was a landmark budget which was presented by the finance minister on 1st February. Basically, it was India's first digital budget that was represented in Made in India tablet, which was wrapped in the red velvet cloth. The budget basically unveiled with the hope of economic recovery due to the pandemic with the objective to attract foreign companies to do business in India with a long-term commitment of low tax regime, benefits to startups. The budget has also set the tone to boost and revive India's economy and with a clear vision and plan for significant increase in capital expenditure, infrastructure development plan, increasing permissible limits of FDIs in insurance sector, promoting domestic manufacturing, including privatization of 2 banks and 1 general insurance company, along with asset monetization to ensure that the government has enough money to push economic growth. This year's budget did not increase the corporate income tax rate. That's a very big incentive that the government of India has provided to companies, that they did not increase the corporate income tax rate. And this was purely with the objective to attract foreign companies to do business in India with a long-term commitment of low tax regime and a benefit to the startups, and also to improve the traction in the M&A and foreign investments in the post-COVID India. The government of India has also focused on attracting foreign companies to shift their supply chain and also think of India as a global manufacturing hub by reducing the corporate rate, as mentioned, to corporate income tax rate of 15%. So this was a very good incentive the government of India came out with a couple of years back, that they wanted to grow the manufacturing sector in India, and they decreased the corporate income tax rate to 15% in the manufacturing sector. And last year, the government also proposed the prod and click incentives, which is the PLI, to attract foreign companies to shift their supply chain to India. Some of the other reforms the government has proposed in this budget are increasing the FDI limits in the insurance sector, that is to 74%, and foreign ownership and control will be allowed. This is a good incentive in the insurance sector that in addition to the 74% limit of FDI limit has been increased. Also, consolidation of multiple securities law into a unified securities market code expansion, and expansion of small companies, and easing of the rules for a 1-person company. The budget has also proposed resolution on the stressed assets by setting up the Asset Reconstruction Company Limited and Asset Management Company to be set up to consolidate and take over the existing stressed debt and then manage and dispose of assets in the AIF and other investors. Furthermore, in the line of doing business in India, various administrative reforms were also proposed in the budget, such as faceless tax assessment and tax tribunal level to reduce litigation, pre-filing of returns, reduction in the timeline to reopen tax assessments, and setting up dispute resolution committee. And my learned friend Bala will be talking more about the budget, benefits that and the budget incentives and proposals that the government of India has come out with. But right now, I'm going to focus a little bit more on the financial sector. That what does the budget that came out has some amendments and provisions in the financial services sector. So going back to the FS sector, since 2015, and as everybody's aware that India has launched the International Financial Services Center, which is the IFSC, in the state of Gujarat, which is also called GIFT City. Post the setup of the GIFT City, there were path-making regulations and policy announcements by the government of India to attract foreign investors. The objective was to make India an investment getaway, providing global financial and easy access to one of the fastest growing economy in the world. There were several regulatory and tax changes made to the framework of the IFSC GIFT City in the state of Gujarat for the last couple of years. And some of the proposed incentives the government has provided in this budget to attract foreign investment for the gift city or the IFC is relocation of the IFC fund will be tax neutral. What that means is that any funds that are headquartered in Mauritius and they have been grandfathered, they can move their investment to the gift city, to the IFSC, and any movement of those funds will be taxed until there won't be a capital gains tax exposure. And there'll be an exemption from the capital gains tax perspective if you move your funds from Mauritius to the gift city. The amendments made to the provisions related to cost of acquisition, gift tax applicability, and protecting losses of Indian company held by foreign shareholders has also been provided in this budget. Also, on income earned by non-resident on transfer of non-deliverable forward contracts entered into with an offshoring banking unit of IFC will also have some tax benefit. Tax holiday has been proposed to be extended to income earned by unit in the IFC from transfer of aircrafts or aircraft engine, tax exemption of royalty income of a non-resident from lease of aircraft to a unit in IFC unit. These are some of the incentives that the government has provided for the IFSC. In addition to that, the foreign portfolio investors in the FIIs have also been one of the biggest drivers for the India's financial markets. Last year, the government of India had abolished dividend distribution tax to introduce the dividend withholding tax regime. To attract foreign investment, this year's budget has proposed to provide that the advance tax liability on the dividend income shall arise only after the declaration of the payment of a dividend and not on accrual, a very positive move by the government of India. In addition to that, the budget has also proposed for an amendment that will allow Indian companies to withhold tax at the tax treaty rate, ranging from 5% to 15% depending on the country of residence of the FPI, instead of current rate of 20% providing under the domestic Indian law. This was strongly demanded by the industry leaders and bodies, and so finally the government of India has taken this position, and the benefit can be availed by the companies who are looking at investing into India using the financial services sector as a way of investment in India. And this investment or benefit will be available from April 1, 2021. In addition to that, the budget has also rationalized provisions for sovereign wealth funds and pension funds to make further investment into India. Some of the measures include relaxation for AIFs, investing into the infrastructure facilities, extensions of exemptions to the sovereign funds and the pension funds, investing through non-banking finance company infrastructure, debt fund infrastructure finance companies, also allowing the sovereign wealth funds for and development of infrastructure in the backbone of the economic growth and stability of the country. Finally, I would like to highlight that there are certain other provisions on the REIT side, the Real Estate Investment Trust and the Infrastructure Investment Trust, where the government of India had introduced this back in 2007 with the primary objective that an organized market for retail investors, a professionally managed ecosystem that is risk averse, and an exit platform for the real estate sector to ease out liquidity and burden. Much like REITs and Infrastructure Investment Trust or InvITs was enabled to direct investment of small amounts of money from possible individual institutional investors in infrastructure to earn a small portion of the income as a return. The budget is proposing that a direct investment in the infrastructure entities or in units of AIF or infrastructure units can be allowed. Debt financing of the Real Estate Investment Trust and Infrastructure Trust will be enabled by making a suitable amendment to attract more investments. And finally, the budget is also proposing that the dividend income received by a business trust from these specified SPVs are now exempt from tax deduction at source. So these are some of the nutshell of the proposals that the Indian budget has come out in the financial sector. Now, moving back to the Biden administration, I'm going to bring in my friend and my colleague, Dan Mayo, to talk about what does the Biden administration is proposing on the tax proposals from the U.S. federal tax perspective. Over to you, Dan.
Great, thanks, Raj. And if you hear some noise, I apologize. There's some construction going on near me, so hopefully we can minimize that. So the first thing is the administration is talking about increasing the corporate tax rate from 21%, which is the current rate, to 28%. And this is a fairly sizable increase in the tax rate. And it would be a flat rate though, right? It used to be prior to 2017, we had a graduated tax rate that capped out at 35%, around the $10–11 million income mark. Then it was switched to 21% in 2017, the end of 17, with the Tax Cuts and Jobs Act, and Biden is proposing to increase the rate. Keep in mind that the U.S. government will be in need of significant revenue raisers, given the amount of spending that's been taking place in the last year, particularly. But also, the latest proposal is to spend 1.9 trillion in the latest stimulus legislation, which is expected to pass within a week or two. So that's the first thing. Similar to that is there's talk about phasing out the 199A, that qualified business income deduction, for people making over $400,000. So this applies to pass-through entities, S corporations, partnerships, those kinds of entities. So the QBI was meant to equalize. When they reduced corporate rates from 35 to 21%, the thought was they needed to equalize that for pass-through entities, because the income would flow through to the individual and be taxed at the maximum rate of 37%. So they passed this QBI deduction, which is a 20% deduction on your qualified business income. And so what the effect of that is to equalize the rates for non-corporations to be consistent with the tax cut for corporations. Well, once you raise the corporate rates, I guess it makes sense they're going to phase out that QBI deduction. But again, only for taxpayers making more than $400,000 per year. There's also some talk about tightening the opportunity zone regime. It may not be a huge deal for some foreign investors unless you establish residency in the U.S., but the opportunity zone regime is an investment regime to benefit capital gains. So there's some talk about tightening that. There also was an extension recently, if someone is interested in that, to the end of March. They extended the reinvestment period, the 180-day reinvestment period, to the end of March. So you have another month and a half to reinvest. Some other things, the biggest thing, I guess, for the large companies that Biden proposed on the campaign trail is a new 15% tax on global book income for companies with at least 100 million of income. And there's not much detail in this proposal other than it's a new tax on book income, not taxable income. So similar to other proposals, we have 451B in the U.S., where they tried to say that if you have income for book purposes, you have to recognize it for tax purposes no later than when you recognize it for book purposes. So the concern here is that companies are recognizing book income but no taxable income. So this is it's a new tax, and two, it's consistent with that theme of making sure that the book income is equal to taxable income. Other proposals include limiting some real estate, the ability to use real estate losses. But again, this is possibly only for taxpayers earning more than $400,000 a year. And there's talk about repeal of the like-kind exchange rules. Another thing I'll mention, the last point I'll mention on the rates is the increase, which I think Raj alluded to briefly, the increase in rates for long-term capital gain from 20% to 39.6%, almost doubling the capital gains rate. And that also applies to qualified dividend income, but only for taxpayers earning over $1 million a year. So the thought is Biden has said on the campaign trail now, President Biden, that he won't raise tax in the middle class. I guess he defines middle class as earning less than $400,000 a year, which is somewhat interesting. But I'm sure these numbers are going to have to come down, those income limits, because they just need the revenue. And, the government has spent trillions, at least 4 or 5 trillion in the last year. Another 2 trillion is about to be spent. So I think revenue raisers are going to be top of mind, and they're going to be looking for them, a lot of them. I want to mention briefly 2 other things, the PPP and the employee retention credit. Those are big issues these days. PPP is a paycheck protection program. It's a forgivable loan program that came in with the CARES Act back in last March of 2020. And in this program, the first round of it was exhausted in April and May last year. People are still going through the forgiveness process where you apply for loan forgiveness. We're seeing a lot of companies applying forgiveness, and also in the M&A context when they're buying and selling businesses, it comes up, how do you deal with the PPP loan? So we've seen that a few times already. And then also the PPP2, they're calling, the second round of the PPP opened up a few weeks ago. So a lot of businesses are getting the second round of PPP funding, but it's only open for businesses that have a 25% drop in their gross receipts relative to 2019. So it's a more tailored and targeted relief for those hardest hit businesses. And the last thing I'll mention is the employee retention credit. This is the biggest opportunity we're seeing these days for U.S. employers. It's similar to the PPP in that it's intended to compensate employees. The companies get a up to $5,000 credit per employee for 2020, and they can receive up to $14,000 per employee in 2021. So the amount of the credit depends on if there's some eligibility requirements, either drop in revenue or partial shutdown of your business. There's limits on who can claim and the amount of credit you can claim based on whether you're under 100 employees or over, or in 2021 under 500 or over 500. So there's a lot more detail to the rules, but we're seeing some clients receive a couple $1 million back on this employee retention credit. So it can be a fairly significant thing. If you just take a company with 100 employees at 5,000 per employee, you can see why it's a large opportunity. Right. And so the employee retention credit is one of the biggest things we're seeing. Most recently, we have at least 30 calculations in progress for companies to get refunds. It's a quick refund opportunity, and it's the only other restriction is you can't double dip the employee retention credit with the PPP loan. So it comes down to pretty much a large mapping exercise. When we do the calculations, we need to ensure there's no double dipping. So that's the latest of what's going on, I guess, here in the U.S. In terms of proposals. I just want to highlight, too, there is no one document where Biden laid out all of his tax proposals. So a lot of these things we talked about come from a combination of statements and policy documents that were put out. But there is no one comprehensive list of now President Biden's proposals or ways in which he wants to increase taxes. And I guess that that makes sense, because the more specific he is, the easier it is to attack. And it would have been for his the Republicans to attack. So they prefer that ambiguity because it's it's intentional ambiguity. So with that, I guess I'll turn it over to you, Bala, and take the floor, please.
Thanks, Dan, and thanks, Raj, and thanks, Nilima, for having me on this event. It's my pleasure to share my thoughts from an industry perspective, both on the Indian budget and also what we are going to see in the next few years from the Biden administration. First, I'll start with the Indian Union budget. Raj made a very detailed statement on various nuances from the Indian budget. So I'm not going to spend a lot of time. I'm just going to give a broad view of my perspective on this, and then probably we can take it a little more in detail in the Q&A as we proceed into this discussion. So, I think one has to understand the backdrop in which, this union budget was presented. Budget, as we all know, from an Indian side is a statement of intent from the government in terms of, what they intend to spend on and where they are expecting to raise revenues. So it's more a policy document. So the detail is always is in the implementation and the execution of the plan of action. So, but from an intent perspective, I would say that given the backdrop of the pandemic, given what this government had done on the corporate tax reforms, in the middle of 2019, and the grand GST implementation and the stabilization phase that has followed 2017, we were expecting that the growth would come into double digits in this fiscal, but unfortunately the pandemic took the forefront, and therefore the government had to intervene at multiple points in time last year. Last calendar year, if you look at it, 4-5 mini budgets were presented outside the parliament, of course, by the finance minister. Those were all qualitative measures in terms of how the government wanted to respond to the pandemic situation, as we all were in the deep of the pandemic. But having seen the worst of the pandemic, and now we are getting into the phase where we will have to respond to the post pandemic scenario. So this budget assumed a lot of significance, and Raj alluded to some of them. But to me, I would say there are three aspects of this budget that one has to look at. One was the transparency with which the government approached some of the spending, and how they brought in certain items of subsidy and expenditure into the budget. The second was on the improving the quality of spending, right? You can if the government is going to spend a lot on revenue and not on capex, then the larger fiscal deficit is not going to make any sense, and it's not going to have a multiplier effect on the economy. So the second key aspect that was important was the improving the quality of spending. And the third is, as Raj mentioned, everybody were expecting a corporate tax increase, or at least a COVID cess on certain high net individuals, or corporate entities. So I think the honorable finance minister took everybody by surprise in terms of not increasing taxes in any form or shape, and then therefore focusing on non-tax measures for increasing the revenue. I think that's a very key positive from the budget, and that's where the markets reacted very positively in terms of not resorting to increased tax rates from the budget. So from that perspective, if you look at if we just deep dive into these three aspects, from a transparency perspective, I think you all would have noticed that the fiscal deficit has had hit the roof with about 9.1% for the current fiscal, and a target of about 6.8 for the next fiscal. But a key component of this it goes into accounting the subsidy which was outside the budget, as we call as the non-budgetary support that the government gives for certain subsidiary activities. I think the government took a very bold stand of bringing that into the budget, and everybody looked at it with positive spin on this, because the government has an intent of walking the talk on transparency, and that's a very key thing, because the government can say I have controlled the fiscal deficit at 3%, but if there are a lot of non-budgetary things going on, then those things don't get counted in the larger economic issues. The second aspect is on the banks, right? Last few years there have been a lot of issues on the banks, the non-performing assets, the twin balance sheet problem, as we used to call in India. I think things were starting to settle down. Bold measures on bank mergers were taking. The public sector banks were brought down significantly, and a lot of mega mergers of banks was were executed in the last few years. And as a sequel to that, now the government has introduced what is called as a bad bank, an asset reconstruction kind of entity, where the banks would be encouraged to sell their bad loans into this bank and concentrate on their core activity of banking operations. And and the segue, and the natural segue into that is targeting the credit growth, because if you look at it, even pre-pandemic, the credit growth in India was in the low double digits, and they always say that the credit growth is a function of the GDP growth itself, and therefore if we have to aspire for a good double-digit GDP growth, the credit growth should be somewhere in terms of in the range of about 17-18%, but we were reeling in about 9 to 10%, and therefore a lot of quantitative measures had to be taken, and the Federal Bank of India, which is the Reserve Bank of India, came up with structured policy on monetary aspects, and the government also provided the required funding for the banks, so that there is substantial availability of liquidity in the market, and the guarantee programs that the government executed in terms of providing the MSME, the micro, small, and the medium enterprises with the ease of the credit availability, and the trust factor between the bank and the borrower and the lender was also required to be built, because of the NPA situation. I think the credit growth was not taking off, and therefore the government had to intervene and look at the credit growth aspect as well. So I think from an intent perspective, these were some of the fiscal measures that the government had taken in terms of the government support to the financial markets. From a quality of spending perspective, this is a year where the government has to concentrate big time on the healthcare, and when we have a large population such as India, which has to go into the vaccination, laying out a healthcare spend of about $28 billion, which is twice what was there in the previous fiscal year, is a very laudable thing the government has done, and part of this is towards the vaccination. $7 billion, sorry, $5 billion of support for just the COVID vaccination has been laid out in this particular budget, and that was the need of the hour, and the government recognized it and has incorporated it in this budget. And the second aspect is on the infrastructure. As Raj pointed out, more and more of the budgetary spend going towards capex creation will always have a multiplier effect, and therefore a big push on the infrastructure projects has been undertaken. And one of the key aspects of any infrastructure project is the faster completion of these projects, and the execution is a very key, because you have to have the cost under control, etc. And then therefore they have laid out a plan of action on the infrastructure development, and that's a very key thing. And the last of the aspect that I mentioned was on the revenue side, which is the non-tax measures undertaken to increase the revenue without an increase in the tax rate. Measures like the disinvestment, measures like increasing the FDI limit, for for the insurance sectors, laying out a plan of action for privatization of banks, etc., is also in the annual. But if you look at the tax revenues, we are coming off of a historical low in terms of the tax revenue. But we saw at the end of the fiscal year, the GST collections, the goods and service tax collections, touching a very all-time high. And then therefore we are very hopeful that the tax revenues would compensate for any of the shortfall on the non-tax revenue measures that have been laid out. But having said that, a modest growth of 15% is what is being considered in the tax revenues, which is a very modest target, I would say, in the recent times, given that the industries would be performing with a double-digit growth, and that's what the RBI and the global financial institutions are looking at for India, and with a nominal inflation, etc. We would have a tax revenue which would be more than 15%. But for budgetary purposes, I think a very modest estimate has been undertaken. So which would also mean that there would be less pressure on the businesses in terms of the tax assessments, etc. And the last thing that I want to lay out on the tax side is the reforms that this government has undertaken, or have undertaken in the last few years, is on the assessment procedure, as we call in the US as the audit procedure, the appellate mechanism, and the tribunals. They are all going on what is called as a dynamic jurisdiction and a faceless mode, which would increase the transparency, be the efficiency part of it, and also see, in terms of uniformity in terms of the rulings that we would get from the income tax authorities. So I think that's a very key thrust area which the government has undertaken. Time will tell, how successful we are, but the intent is very, very loud and clear, and the government wants to go very quick on this, because the way in which the faceless assessments and the audits and the appellate mechanisms have been implemented. What was supposed to come a year later, they have preponed it and got it during the pandemic period. It's a very laudable step, I would say, step in the right direction. But we will have to see how the implementation is done on that, and the businesses have also committed to support the government on this, and so we will wait and watch on that. Uh, Lastly, on specific tax proposals in the budget, Raj alluded to many of the incentives and many of the things that have been done for the non-residents. Two or three things that stand out for me, I think, which we should all be very clear, is on one is on the goodwill amortization. There's an amendment which has been proposed to be done in the finance bill to take away the goodwill amortization for any purchase of business or any reorganizations which would happen in terms of the amalgamation or merger. So that's a change in the business modeling that we will have to look at whenever we evaluate mergers and acquisitions going forward. And that's an amendment which has been done, which is not very positive for the businesses, but we will have to kind of take care in our M&A business modeling. The second is, certain changes have been done on the equalization levy, and one of the change was on the overlap of the equalization levy and the FTS provisions, in terms of the levy being there, for the current fiscal, both the levy being there for the current fiscal. The government has clarified on that, and the government has taken a step further and clarified what will happen when there is an overlap between FTS and equalization levy. So those are positive clarifications which have come. The third aspect is, we all have to be clear about the withholding tax provisions in India. Right, more and more stress is being laid on right withholding, the right rate being applied, and the person from whom the tax is being deducted, his compliance will also be taken into consideration while looking at the rates. So withholding tax regime in India is becoming very onerous in terms of the deductors, liability and the responsibility. So we will have to be watchful of this regime as we move forward, because lot of trust is being laid on the withholding tax regime as far as India is concerned. So I'll stop here, and we will take questions as we move into the panel discussion. Raj, thank you.
Thanks, Bala, and I think this is a very good, snapshot of the Indian budget as well. I think the first question I would like to propose to ask you, Bala, is that there has been a lot of activity in the past few years on the PEPs, and many countries, including India and US, as I had alluded earlier, that in US has also taken they have amended the Tax Cut and Jobs Act, came into existence in 2017. Guilty, FDII, BEAT rules have come up. So what is your, especially in the taxation of digital economy, what is India's position? And how do you see it evolving, especially knowing that your company is, headquartered in India with a strong presence in the US? What is your thoughts around that?
So, I think two or three things which I think most global, countries adopted was in the area of, interest deductions, right? UK came up with restrictions on interest deduction. US, introduced provisions. Likewise, India also, introduced provisions to limit the interest exposure on the intercorporate loans. And that's those are minimum things that the countries did. But what India went ahead and did was on the equalization levy, as I mentioned, on certain digital purchases that the businesses in India would do, and a levy was introduced in terms of these spends. So this was mostly to attack the digital economy in terms of their tax liability in India on these spends, and that's been the Indian story on the equalization levy. And there were a lot of issues in terms of how this equalization levy would be addressed, what would be the interplay with the fees for technical services regime that is already in vogue, and what would be the the rate of tax, and how it would be implemented, and how the collection would happen. Those were the concerns that were there. I think the government has clarified most of them as we speak today, and so that's been the Indian response to some of these proposals. But as far as the OECD proposals on pillar 1 and pillar 2 are concerned, in terms of the permanent establishment taxation, I would say that it's too early to make any comment on this at this point in time, because the views are still emerging, and therefore we'll have to wait and watch. But the Indian government has already taken a step forward in terms of implementing a rule called as a substantial business presence in the domestic law. While the rules have been passed, they have not yet been notified, and therefore the implementation of this was paused by a year. But we are fast approaching the deadline, and therefore we are expecting the government to clarify their stand on how they would like to go about on the substantial business presence. And this is something that as a chamber of commerce, we should be working with the government in terms of positioning the right regulations on this particular aspect.
No, I agree, Bala. Thank you. And I think US is already objecting to the equalization levy on January of this year. They already have started an investigation. There's a report that came out. So I think this is something that both the governments have to sit and discuss and try to clarify. Going back to Dan. Dan, I know that currently there's a Democratic controlling, presidency at the Congress. What are the chances that the President Biden can accomplish as far as the tax agenda goes that we have discussed about, especially with the GILTI and corporate income tax rate is going to go up, and also for high net worth individuals, So what are your thoughts around that?
Yeah, so the Democrats, obviously they have the White House and they have control of the House of Representatives. There's a 50-50 split in the Senate, which means that the tie-breaking vote that was cast by the Vice President, Kamala Harris. So the Democrats do control the Senate with obviously a slim majority, right? So if they had bipartisan support on legislation, it would be much easier to get it through. In terms of tax legislation, what can they force through is really the question, right? What can they force through the Senate in Congress and have President Biden sign? And I think in that score, it really comes down to the reconciliation process, and they're allowed to have one tax bill and reconciliation bill a year. So it's not like you're not likely to see you won't see drips and drabs come through. There'll be one bill a year that can go in under that reconciliation process. So I think that's how we're likely to see. There's other restrictions also on the reconciliation process, but that's how they're probably going to get it through. It's not likely to come with bipartisan support.
Right. No, thanks, Dan. I think the third question I would like to ask Bala. Bala, I know that in the last few years, both India and US have seen, significant reforms, as far as the corporate tax rate goes. There's a reduction in that, significant stimulus packages. Both the governments have come out with, What has been the impact of these reforms, and how will this play out in post-pandemic scenario, especially knowing that you're from the industry and your business has been impacted, significantly both in the US and India?
No, I think from an Indian perspective, the tax reforms in terms of the tax rate reductions were implemented in September 19, and before we could see a full year of the benefit of this flowing down. We had the pandemic, right? And therefore, the businesses were worst hit by this pandemic, and some of the deadlines in terms of businesses going live, etc., were all put off by 4, 5, 6 months, and therefore people couldn't see the full benefit of the tax rate reduction. And added to that, in the first few months, post the ordinance which came in September, there were a lot of confusion on what is in, what is not in, what should be counted as other income, etc., etc. So there were a lot of issues in terms of the clarifications which were required from the government, and therefore there was a delay in terms of the businesses adopting to the new regime. So post pandemic, I think this would gain a lot of significance. But in between, another thing which happened in the tax administration in India was, in fact, two things happened. One was what is called as the voluntary dispute resolution scheme, as we call that as the Vivad se Vishwas scheme. It was a dispute resolution scheme which was introduced, and the government raised a significant amount of revenue from this particular scheme, and it reduced a lot of disputes from the small and the medium businesses, and some individuals as well, I would say. uh, so and added to that, as I mentioned, the government has introduced what is called as a faceless scheme. So these two are, I think, same, two sides of the same coin, and therefore this would have a significant impact in terms of how the administration reacts to it in the post-pandemic situation. So we will have to wait and see in terms of how this takes off. But I can tell you, in my conversation with a lot of my colleagues in the business, they see this as a positive momentum, and a lot of businesses have adopted the new tax regime, which is the 22% with the surcharge, etc., coming up to 25%. So it's a very positive development from an Indian perspective, and the new businesses, new manufacturing setup being entitled to 15% is also being looked at it positively. And the third aspect is what you mentioned on the product, the production linked incentives, and that's going to be a significant driver for businesses to look at new avenues of setting up operations and manufacturing, what was not being done previously in India. I think these are very key aspects that we will have to look at as we move from the pandemic into the post-pandemic situation, Raj.
Sure. Thanks, Bal. I think one question that I'm going to ask Dan specifically, knowing that the stimulus package the government has provided in the U.S., what can any business in the U.S., new business, or let's say I'm a client, my business get a PPP loan if it is owned by an Indian company? And what if we have more than 300 employees in India? What are your thoughts around that, Dan?
Yeah, so the non-U.S. owned businesses can get a PPP loan as long as they have U.S. employees, but you do have to aggregate. There are aggregation rules, so you have to combine the number of employees in the U.S. entity with the non-U.S. entity, so the Indian entity here. So if you had 1,000 employees in India, but only 50 in the U.S., you would not qualify because you have too many employees. So you have to look at the aggregation rule in connection with that. Also, you had to be in business on February 15th of 2020 in order to get a PPP loan. So a new business now wouldn't qualify.
Great. Just on that note, does the employee retention credit apply in 2020 and in 2021? Just to continue that discussion, Dan. Can a company right now apply for the employment retention credit?
Yeah, so people that qualified for the 2020 retention credit obtained it, months ago. The change was at the end of December, they passed a rule Previously, if you obtained a PPP loan, you were barred from claiming the employee retention credit. So a lot of people just didn't even bother looking at the specifics of the credit because they knew they got a PPP loan, and a PPP was more favorable. When they amended the rule this past December that said if you got a PPP loan, you can still get the employee retention credit. So it opened this retroactive refund opportunity to go back, and some companies are getting $200,000-$300,000 just free money from the government because they can now claim the employee retention credit. So we're seeing this retroactive refund opportunity for 2020. There's also an expanded employee retention credit in the first 6 months of 2021. So you can get it, as I mentioned, up to $14,000 per employee in 21. Also on the table is one of the proposals for the stimulus legislation. The next round would extend the 2020 employee retention credit to the end of the year, so it'd make it even more generous. So yeah, there is a 2020 opportunity and the 21 opportunity.
Thanks, Dan. So, Bala, there's a question from the attendees. In the present Union Budget Proposal 2021, the Finance Minister has disbanded the Authority for Advanced Rulings and substituted it with the Board of Advanced Rulings, along with making the rulings non-binding and appealable before the high courts. Don't you think this step would only delay tax certainty for foreign entities, investors looking for transactional closures? Any thoughts around that? Bala, you're on mute. Yeah.
Yeah, sorry. So I think we'll have to look at the dispute resolution in a larger landscape, right? I think the change of the advance ruling, the scrapping of settlement commission, some of these are part of the larger dispute resolution mechanism which this government is trying to put in. The first of the step was the Vivad Se Vishwas scheme, as I pointed out. Number two is the faceless schemes for both audits and the appeals. Now they are trying to bring what is called as a tribunal, the income tax appellate tribunal, which is the second appellate authority. That is also within a faceless scheme, so that there is a transparency and efficiency in the tax dispute resolution. Now, some of the alternate dispute resolution, like the dispute resolution panel, which the government has introduced for small, taxpayers. Probably this would not be applicable for most of us on this call, but that's something that they have introduced. The second thing that they have done is on the reopening of concluded assessments, right? Previously, a timeline of 4 years and 6 years was available for the tax authorities to reopen an already concluded assessment. Now that time limit has been reduced to 3 years. And the search and the seizure provisions, which was more or less like an invasive tax proceeding, that has been tagged along with this particular reassessment procedure, and the time limit has been set as 10 years for certain serious frauds. But of course, there are certain things that we will have to represent to the government on how the intent has not translated well into the finance bill. Will not dwell deep into that at this point in time. But so these are some of the changes that have been done, and therefore, with this in mind, what they have done on the advance ruling is essentially to change the authority from an independent authority to a board, which would be constituted by the income tax officials itself. So the commissioners, the senior most commissioners of the IRS, Indian IRS, would be part of this board. And they would rule on some of these advance rulings that would be posed before the authority. In my view, it's not a very great step from what we had seen on the AARs. But of late, last 2-3 years, the AARs were not functional. We did not have sufficient members in the AAR. We were representing to the government to make the AAR functional. But we did not get too many rulings from the AAR. So from that into the departmental rulings, I think this is a practice which is prevalent in most countries, right?
Right.
We go to IRS and seek private rulings in the US. We can seek, advanced rulings on specific facts, and
Right.
those are rulings provided by the IRS itself. I think we are moving towards the international, practice on advanced ruling. So I don't think we should worry about it at this point in time. We will see how it proceeds, and of course, with all the things, implementation is key. We will give it some time for this new methodology to to stabilize.
Thanks, Bala. I think there's one question that from our, the attendees that I'll take and I'll have Dan kind of highlight that. So the question was any hint on the FDII changes that the Biden team could propose? So just to respond to that, so far we have not seen any comments from the Biden government on the FDII, even though FDII is closely tied to guilty. As I had mentioned earlier, they're closely tied and they're both part of the Section 258 deduction. And FDII operates in tandem with the global intangible, with the guilty rules under 951A. Even though the Biden administration has proposed that the guilty tax will go up to 21%, but we have not seen any comments on the FDII side or any changes that we foresee. That's my understanding. Dan, have you heard anything from when you are working with the U.S. government policy guys, anything on the FDII that we see any upcoming changes?
No, I have not heard of any changes to the FDII, which is surprising because obviously guilty is a revenue raiser, and FDII is a deduction, which is favorable for the U.S. entities. So I've not seen anything about limiting the FDII deduction.
Thanks, Dan. And I think one last question that I'm going to pose before I hand it over to Nilima, and this is an important question for Bala. Bala, as a global company, Wipro, and you are heading their global tax operation, what are the 2 or 3 issues that bother you as a global tax head? And which you're looking at in the short to medium term, knowing that both the governments have, the new president has come into power. India has a very, positive budget, for next 5 years. They want to be a $5 trillion economy. Both US-India partnership is going to be a very strong partnership that we have seen in the last 10 years, So any thoughts around that, Bala?
No, I think, the first issue that I would flag, Raj, is we have all filed the country by country reporting, right? US did not have that, but Wipro being a filer in other major tax jurisdictions in many European countries and Asia Pacific countries, and in India as well, we have all gone through the compliance of country by country reporting and the master file compliance, right? And these would be taken up for audits and assessment in some of these countries, right? So next few months, we will have some focus on the filings that we have done under this particular regime. This would be the first reaction of governments across the globe to our filings, and therefore how we respond to it, the documentation that we have had, and what substantiation that we would have to make for some of the positions that we had taken. I think that will be a very key aspect in terms of the implementation. So this is not a worry, but I think this is I would say off top of my mind in terms of what is to come in the next few months. The second is how the US government is going to look at the tax proposals, how quick they are going to implement some of the proposals with the new Senate and the new president in place, and some of the decisions that we had taken in the past few years, keeping in mind the tax rate reduction and the other changes which had happened on guilty and FDII, how do these would impact our future operations in the US. That would also be a key thing to look out for. And the third is the government's across the globe are going to be starving for revenue. They need to have, while India has not looked at tax as a major revenue measure in their budget, but I think slowly the tax is going to become the talk of any government proposals, and therefore we'll have to see how the tax rate moves, how the assessments, the audits globally are going to pan out, how aggressive these assessments and audits would be, is something that we'll have to keep in mind, because these are tough times both for the governments and the businesses, and therefore I would say fairness would prevail in the balance of equation in some of these actions.
Thank you, Bala. So I think that's where we have run past our time. So I'm going to hand it over to Nilima to do the closing remarks. And over to you, Nilima.
Thank you, Raj. Thank you, Daniel, and thank you, Bala. This has been very good, but I would like, if I could, everyone's patience to ask one question to Dan, Bala, and Raj, which is that if the governments, if the tax authorities in both jurisdictions come together, and there are some dialogues that are happening, such as the US-India financial regulation dialogue, similarly, what would you ask them to focus on? Where do you see most meaningful gains possible? So Raj, I'll give you that question and let you parcel it out as you see fit.
I think the key initiative that I would say, especially in the financial service sector, India has come out with a lot of reforms. Now, the concern I will raise over here is that how India is going to execute those changes and proposals to attract the US investors. And the US investors have to think about it that, hey, these reforms and changes have happened in India. The government of India is acting on those changes and reforms in a timely fashion. And then whether India is going to be a destination for investment, especially in the financial services sector, because we see a lot of changes in the FS sector in India. From the IFSC to your sovereign fund to FII, so there's a lot of changes, provisions and proposals in those sectors. We just have to focus on how the government of India is going to implement those. How quickly will that get implemented to attract the foreign investors, and especially US investors who think about India as a destination for investment. That said, I'm going to maybe have Bala shed some light around that, and then Dan. So over to you, Bala.
So, I think I agree with you. The key is in the implementation, Raj. But another thing that, this government had, taken it upon itself is the ease of doing business, right? And one of the key elements of ease of doing business, of course, is on, the government intervention, the laws being, certain and simple. You pointed out, the combination of the securities code. There are multiple, codes on securities law.
Right.
The government has tried to, bring all of them into one umbrella. The new labor code is going to be is going to be implemented in the next few months. So some of these, reforms are going to be very key on the ease of doing business, improving the ease of doing business. But what is also important is the litigation space. The government is the biggest litigator as far as tax issues are concerned. There's millions of billions of dollars locked in the courts in terms of tax disputes, and the government is very serious about resolution of these disputes as we move forward. And the certainty that this government wants to provide to the businesses, so that they can resolve these disputes and move forward, because at the end of the day, we are in business of doing business. We are not in
Right.
business of litigating with the government, right? And therefore that's a very key ask from the business in the past, and the government has responded very well. We'll see how it pans out in the next few years. So I would say these are 2 or 3 things that the government is doing and must focus on doing as far as improving the ease of doing business is concerned.
Thanks. Dan, any thoughts from your side?
Yeah, I think the government, at least in the US, is going to be most focused on job creation and retention. And I think that's one of their biggest focus areas. There's talk about an infrastructure bill. Again, I think that will come into focus, given it's got a large spending tag attached to it. But to the extent it increases, again, that job creation and retention, I think you're most likely to get traction here in the U.S.
Agreed. And I think one thing I'll also add, Nilima, especially when foreign companies are doing business in the US, I know that there is a proposal for the tax rates to go up, individual tax rates are going to go up for high net worth individuals, but also there are other incentives that the US government is providing, similar to the incentive the government of India has. There is an R&D credit available. There is, state incentives and trade zones that the US government is providing at the state level for companies to consider, in spite of the corporate income tax rate going up in the US from US inbound perspective. So I think both the governments are providing incentives and benefits. It's just that the companies have to take the initiative of looking at those incentives and see how they can work collaboratively to grow the economy in both the countries by bringing and working in both the countries and growing the business.
Thank you, Raj. Thank you to Bala Subramanian and Daniel Mayo for all of your expertise. I know that this has been tremendously insightful and important in understanding the tax implications, the tax drivers, which are the reality that underlie big, broad announcements of an intent to make a change. It's the tax implications that everybody needs to consider when actually making the change in their operation. So thank you, everyone. And we look forward to an update from you at about a 6 month mark or 8 month mark as the Biden administration not only enters the office, but has some time to make some changes. And the government of India has the opportunity to implement the union budget announcements that they've made. So we'd love to have you join us again for a report card or a checkup on how things have happened and, Bala, how you see a company such as yours multi-jurisdictionally develop its strategy based on what you're seeing. And Daniel and Raj, how you see your clients in terms of their perspective, not only for folks such as Bala, who already have established presences, but also for companies who may be coming to you asking the question, we're considering expanding, what is the tax framework in India for us, and would it be beneficial? So as these reforms move forward, we'd love to hear back from you on how you're advising your clients on that question. To all of our participants, I'd like to tell us, thank you for joining us. We will have the recording available, and we will release it as soon as we're able to, and we'll share it with them, who may also make it available on their social media platforms. But it is available on the US IBC's US Chamber of Commerce platform. If there are subsequent questions, I think there were a number that we didn't get to. Please let me know that, if you'd still like answers, and I will connect you to Daniel and Raj so that you can carry on that conversation. And we'll also have the contact information for Daniel and Raj available as well. So with that, everyone, thank you for your time, and we look forward to seeing you come back again. Have a good night and a good day. Thank you, everyone.
Thank you.
Thank you. Bye.
Thank you. Bye-bye.
Thanks, Bala.
Thank you.
Thank you, Raj.